Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Wall Street back in the red so far today. Investors are focused on Washington with new remarks from Federal Reserve officials. Plus, the shutdown in D.C. persists. We're going to have much more on those stories. But right now, just an hour to go until the closing bell, and stocks are lower. You look at the Dow, down about 300 points here. The S&P 500 down about 0.4%. NASDAQ down about 0.3%. Let's welcome in now senior markets reporter Inez Ferrari for a look at the latest moves. Inez.
Josh, and as you were just mentioning, all three major averages are in the red, but take a look at this. I'm going to show you the S&P 500 year to date so you can see here. It's still up 14% year to date, coming off today off of its highs. But take a look from the April lows. The S&P 500 was down below 5,000. It is at 6,700. So you can see the massive rally that we've seen since those April lows. Same situation with the NASDAQ Composite, which yesterday for the first time ever had closed above 23,000. Well, back in April, it was sitting above 15,000. So this has been really a massive rally year to date and since those April lows that we've seen. But today, a little bit of weakness. Part of that also has to do with, we are seeing the 10-year Treasury that's up about 0.4%. And then if you take a look at the U.S. dollar, the U.S. dollar is rising. It's been consolidating a little bit over the last week or so. We've seen a little bit of an uptick over the last couple of sessions. So that has also weighed on the big trade this year, and that is on gold futures, down more than 2%. Also that Gaza plan also weighing on gold, which has been a sort of a safe haven. But that whole debasement trade that we've been talking about, that's been a little bit unwinding today. You're seeing also Bitcoin is down more than 2%. Silver futures, silver has also been on a tear this year. Silver down more than 3% as well. If we take a look under the hood at where we're at with equities, as I mentioned here, the NASDAQ, we're seeing a mixed picture for the NASDAQ 100. You're looking at Nvidia that's up more than 2%. We've got Meta that's up more than 2%, but the rest of it is pretty much in red. And then also over on the Dow, a mixed picture here as well. And looking at the transport, I just want to point out some of the outliers here, and that being Delta today, up 4% after strong earnings, Josh.
All right, thank you, Inez. Appreciate it. Well, PepsiCo reported earnings today, and the company is also under mounting activist pressure. Our executive editor, Brian Savi, joins us live with PepsiCo's CEO now. Brian.
All right, thanks so much, Josh. Ramon, always nice to get some time with you here. I want to start with the Frito Lay business because I've told you this in the past. I've been covering PepsiCo for a long time. I've only known Frito Lay to be in growth mode, but the message I got today is that there's a reset moment going on with this brand. What are you doing to reset Frito Lay, and where is this business a year from now?
Yeah, hey, Brian, thank you for hosting me in your show. Frito Lay is a jewel that has a lot of growth potential ahead of it. The category is large, it's growing. We can grow in meals, we can grow in other occasions as well. Now, there's a few things we're doing. One is making sure we're better at the basics of pricing, the basics of execution, the basics of service levels to the customers, the basic of space. So that is driving some additional growth for us. We're innovating by restaging some of our key brands, Lay's and Tostitos in particular. We're doing some big renovation, eliminating artificials, making sure that communication is centered on ingredients and the food in the product. And then we're launching a lot of new innovation in more functional, more pervasible innovation that will drive new consumers into the brand. So we're very optimistic about the growth of the business. We see the business getting very close to flat this year and into positive net revenue growth over the next quarters. Now, the other thing we're doing is we're right-sizing the cost structure of Frito Lay. We invested a lot in Frito Lay. Some of that was underinvestment. Some of that was expanded capacity. Now we're resizing some of our supply chain, manufacturing, warehouses, go-to-market. That is moving fast. That is impacting our headcount, unfortunately. But it's also, by the time we look at the key metrics of, productivity per employee in making, moving, and selling is now at the levels of 2 years ago, which tells us that a lot of the leverage is behind us, and we'll see an improvement in operating profit at Frito Lay in the coming quarters.
Why do you think the demand hasn't been there to support the investments you put into Frito Lay a couple years ago?
The demand has been impacted by two things, Brian. One is clearly affordability. Middle class and low class households in the United States are stretched by inflation and all the trends that we've been talking about. That is not changing for current times. The second one, I think there is a pivot on what consumers are looking for in snacks. They're looking for more permissible indulgence. They're looking for more functionality, and we need to move the portfolio very fast into those spaces where there is growth. We have a very large permissible portfolio in Frito Lay. It's over $2 billion. That is growing double digit. So we're doing well there. The opportunity for us is to make sure the rest of the portfolio follows that consumer trend, and we get more people in our brand, especially the lower income, the middle income consumers that are looking for affordability, certain price points, so that they can fit in within their budgets. Yeah.
Are you reducing the number of items that Frito Lay sells?
We're optimizing. We're reducing about 15% the SKUs, and it's mostly the tail of the large brands. So those SKUs that are driving less incrementality and are complicating our supply chain, but also in many cases taking space in the store on the shelf for other faster rotating SKUs that should be there to start with. So that's kind of optimization that we're doing in partnership with our customer partners. It will drive efficiency. It will drive more velocity for the total portfolio as we execute better in the store.
Ramon, Elliott, when they disclosed their position in PepsiCo a couple weeks or a couple months back, they put out a slide deck and really calling into question PepsiCo's innovation pipeline. I want to give the floor to you because I've known PepsiCo to be an innovative company for 10, 15, 20 years, if not really for the entire many years the company has been around. What are you exactly bringing to market over the next 6 to 12 months that would fall under, wow, this is a really new innovative product, whether it's beverages or even in the snacks business?
Yeah, I mentioned this morning, we're obviously innovating a lot against protein. So protein will be a space both from Doritos protein. We have also other snacks on the Quaker or some other platforms with protein. And in the beverage business, we're relaunching muscle milk with ultra-filtered milk, no artificials, a high protein level beverage to compete in the marketplace. We're launching a Starbucks and protein proposition for the morning or for mid-morning snacking. And we're also launching a GLP-1 addressed beverage from Propel that will have the right level of hydration, then fiber and protein. So that space I think we've covered quite well. I think fiber will be a big trend. Consumers in the United States have deficiency of fiber, and we're innovating in fiber. I think that's great for our snacks portfolio, where we can have whole grains and some other sources of fiber to give that to consumers still with great tasting product. We're also innovating in the area of eliminating colors and artificials. So when we relaunch Lay's and Tostitos, that would be with no artificials. Gatorade will also have no artificials in the next couple of years. And we are launching innovation in all these big brands with no artificials. Now, there's one particularly I'd like to mention. It's called Naked. It's Doritos and Cheetos Naked, but there will be more brands that will be naked. And naked means no colors. So it's not artificial or natural colors. It will be no colors at all. And hopefully we take the consumer with us because it will be their best tasting flavors now with no colors. I think it will be a great innovation, especially for moms to give it to their younger children, and it will bring new consumers into our brand. So that's just some example of how we're leaning in innovation fast. We're reducing development cycles and testing cycles, and we'll be, I think, we'll be in a good position. Also, as you know, we've been doing some M&A recently on segments of the market where I think we're better off buying the brand, already a scale brand, put it through our distribution system, and scale it up. Things like Poppy, Siete. We got full ownership of Sabra. Those are big platforms that we're scaling very fast. They're not in our organic net revenue at this stage, but they will be as of Q2 next year. So that really will accelerate our performance, and we're very happy with having those platforms in the portfolio.
Ramon, it's my understanding that PepsiCo has talked to Elliott. Those conversations have been ongoing. Is everything on the table with respect to the changes that could happen at PepsiCo? And I'm not just talking about refranchising bottlers. Everybody loves to focus on that. I'm talking about a potential sale of Quaker. Do you still want to be in the breakfast business? We've seen a lot of transaction in packaged food. A lot of these valuation multiples have been pretty hardy. I mean, how drastic do you want to get here?
Yeah, we've had a couple of interactions with Elliott. They've been super constructive, collaborative, I would say. The good news is we're very aligned that PepsiCo is undervalued, and there's a lot of things we can do in improving performance and taking this company to the valuation that it deserves. So there we're super aligned. There's a couple of, I would say most of the things that Elliott is proposing we're doing already. They're part of our PepsiCo 2030 strategy. We mentioned SKU rationalization, reducing costs to invest in growth, adding some new innovation and portfolio in fast-growing areas, et cetera, et cetera. There's a couple of areas where we need to have more discussion with Elliott. One of that is refranchising. Another one is, do we need to prune the portfolio? And we're open to any ideas at this point. We're listening to everybody, all our investors. We welcome any perspective, and we'll do what we think is best for PepsiCo. But yes, we are opening to our ears to understand objectively whatever our investor propose, and we'll take it from there.
All right, well, good luck in those interactions. It's going to take me a while to get used to it all, or a naked colored Cheeto, but I appreciate the efforts. Ramon Laguarta, PepsiCo CEO. We'll talk to you soon.
Thank you, Brian.
All right, Josh.
Talk to you.
Josh, back to you.
All right, thank you, Brian. Coming up, the blame game over the government shutdown continues in Washington. How will the rest of this standstill play out? We're going to get you everything you need to know. Plus, more Fed officials speak today. Are there more clues for investors to focus on? We'll bring you the latest there. And why are investors putting the brakes on Ferrari today? We'll explain those stories and more coming right up. The government shutdown is in its second week, and pressure building on lawmakers with cracks forming in the Republican Party. Yahoo Finance Washington correspondent Ben Worschel joining us now with a closer look. Ben. Ben, I think you're muted there. All right. Coming back to Ben, hopefully, because we know he has important things to tell us. But meantime, as we work out those audio issues, another busy day on the Federal Reserve calendar. We've heard from several officials on the health of the economy, gave a glimpse at the future of rate cuts as well. Jennifer Schonberger giving us the details. Jen.
Hey there, Josh. We heard from Fed Governor Michael Barr earlier today, who says he favors a cautious approach to lowering interest rates, given uncertainty about whether tariffs will push inflation persistently higher, breaking with other colleagues on the Federal Open Market Committee who've more blatantly favored further interest rate cuts this year. Barr is concerned about the risk inflation from tariffs could prove more persistent than short-lived, and expressed skepticism that the Fed should fully, quote, look through higher inflation from import tariffs. He said, quote, there has been nothing one-time or predictable about these tariff increases, which have ratcheted upward this year on particular countries and sectors in a series of steps. Barr estimates that the effective tariff rate is about 11% as of August and is expected to climb higher. At the same time, he did acknowledge weakness in the job market and said that the Fed needs to be prepared if things deteriorate. Barr's comments just underscore division within the Federal Reserve, even as most policymakers have said that they favor further rate cuts this year. And we also heard from New York Fed President John Williams earlier today, who says he's more concerned about the job side of the Fed's dual mandate than inflation, given slower payroll growth and hesitancy of employers to hire. Josh?
Thank you, Jen. All right, the government shutdown is in its second week and pressure building on lawmakers with cracks forming the Republican Party. Yahoo Finance Washington correspondent Ben Worskell joins us now with a closer look. Ben.
Yeah, Josh. So the waiting game here in Washington early on in this shutdown was essentially waiting for Democrats to crack, waiting for this kind of GOP pressure campaign to bring moderate Democrats on board. That hasn't happened. And what we've seen is in the last couple of days is a shift towards the question of whether Republicans are the ones feeling the most heat. And there are signs that so. This comes after 6 rounds of voting over the last 2 weeks that have seen the GOP effort to end the shutdown on its own terms fail again and again. There was a vote on September 30th before the shutdown even started that saw 3 members of the Democratic caucus vote for the GOP plan, 1 Republican vote no, everyone else under party lines. We had another vote this afternoon, exactly the same lineup of senators. So we're just not seeing any movement here, and we're seeing increasing restlessness on the GOP side, especially as figure of special focus is Representative Marjorie Taylor Greene. She has broken with her leadership and said not only does the House of Representatives have to come back, they need to talk about this healthcare issue, expiring Obamacare subsidies, which is the main Democratic ask for negotiations on there. As for Speaker Mike Johnson and Senate Majority Leader John Thune, they say no change. They're going to keep sort of forcing this. Speaker Johnson isn't even committed to bringing the House of Representatives back next week. They've been out for a few weeks on recess. So there's still a standstill here, but the increasing watch here is whether the Republicans are the ones to fold. And overall, this is spiking the odds that any sort of short-term fix to the shutdown is increasingly off the table, and what we're going to see is a negotiation at some point potentially that could take a longer time and be a little bit more unpredictable in terms of when this ends. That's of course the most important question for economists in terms of how long this goes on as the economic costs begin to toil. But we're sort of headed into another weekend, probably no Senate votes, and another standoff continuing, the question being whether talks start again next week.
All right, thank you, Ben.
Mm-hmm.
The Fed's Michael Barr calls for a cautious approach in adjusting policy. This coming as the Fed is facing even more uncertainty amid the ongoing government shutdown, which is cutting off access to key economic data, potentially saying the rate cut path may hit a detour. Here to discuss this and more, we have RBC Capital Markets U.S. economist Michael Reed, along with Guidestone Fund's President and Chief Investment Officer Brandon Pizzurro. Welcome to you both. Michael, I'll start with you as the economist on the panel. I mean, one question for investors, Michael. As the government shutdown kind of persists, and as Ben was just kind of indicating there, it feels like tensions are actually only getting kind of worse here. What that really does mean for our central bankers, for the Fed, how that complicates things for them. If they don't have the hard data they need, Michael, they're not getting the government jobs data, they're not getting the inflation data. What does it mean for them? What does it mean for this next meeting?
Sure. Yeah, good to be here. So there's a lot to talk about here. This shutdown comes at a critical juncture for the Fed. As we were talking about earlier, you're seeing a slowdown in the labor market on the one hand, and on the other hand, you're worried about the continued rise in prices due to tariffs. So as you continue to monitor that, we're missing out on data that really will start to dictate which way the Fed starts to lean. Now, prior to the shutdown, it was really looking like the labor market was slowing down. And so what the Fed would want to see was signs from other labor market data that is set to be released that maybe that was stabilizing. Now, you have alternative data sets, and we can talk more about those. But even with those in hand, I think the Fed really has to be cautious. The other mandate in terms of prices, you don't really have a good alternative data set there. So I think the conundrum for the Fed will be, do you rely on the known labor market data with some of those alternative data sets, or do you kind of wait to see and take a pause here until the data is released?
So if this government shutdown persists, Michael, and the Fed doesn't have that data, what are the odds to you that they hold because of that? Because they just don't have line of sight. Is that increasing?
We think they will pause at some point, whether it's due to the delayed release of data now, or due to some of the data we get later on. And what I mean by that is, it's not just the data that we're going to get in October. There are ripple effects to these delays. So if you think about the CPI, the data that is collected for October is not being done right now. So those workers are at home. That increases the odds that you're going to have data imputations that'll be released in November and calls into question the quality of that report. And then relative to that in December, you're going to get the November report. And relative to the imputed data, the Fed may have questions around the directionality of some of the price changes. So you're really going to have 2 or 3 months where the data quality is going to be called into question.
Brandon, I want to bring you in here as well. Now, you're looking through this through a different lens, Brandon. Walk me through how you're thinking about the government shutdown.
Sure. Yeah. Thanks for having me. Certainly, we're on day 8, as you've probably seen some countdowns on various news programs, and that's about the average number of days we've seen in a shutdown going back to the mid-70s. Your other guest is absolutely right in terms of data integrity. Leading into this, if you just take CPI, for example, historically, you've seen about 10% of the basket of CPI goods that are estimated by staff. The last couple of months, you've seen that tick up to about 1/3 of the CPI underpinnings within that data calculation. So you're getting murkier and murkier data. There are a lot of alternative data sets. It's not the 1980s or even the 1990s, so that helps from a mosaic approach. But still, there's a little bit of inference that needs to be had here. The Fed and then also market participants. We are seeing about a quarterly GDP drag estimate of about 10 bips per week as long as this drags on. And by the way, that's about $400 million per day in compensation that federal workers are not getting to put in their pockets and then spend into the economy.
So, Brandon, what about this topic? I was just talking about there with Michael. Let's say the Fed decides, you know what, the government shutdown is persisting. We are not getting the hard data we need. We don't have the line of sight we need. We're going to hold here later this month, this next meeting. I'm curious if that was the case, how do you think markets would respond and react to that?
They wouldn't respond well, because if you look at the meeting minutes that just came out this week, the underlying tone was that there was going to be this continued kind of glide path of continued rate cuts. I think the question that was raised there that a lot of people have already prognosticated on is how many cuts we get from here. So the next cut that we're seeing is more than likely a go. However, if there was too murky for the Fed to make a decision and pause, that would certainly throw markets into a tailspin, because as you know, they've been pricing in these cuts well in advance of the cuts actually being received. So that'd be a big detour and inflection point with this market trajectory.
Michael, we don't have the government data, but as you were mentioning, you have these alternative data sets. When you look to those data sets just as an economist, do they completely fill in the gaps here, or do you feel like you don't have full line of vision?
Unfortunately, we don't have the full line of vision. And what I mean by that is sometimes you can get the direction right, but you're really missing out on the magnitude. Even with some of the better alternative data sets that are out there, for example, for the payroll report, there are pretty wide ranges of estimates. I've seen anything as high as 60,000 for the September estimate, and as low as negative 30,000. So that's a pretty wide range. You also don't have a good sense of what that means for the unemployment rate. And going back to the Fed and what it means for them, they focused on that as a better measure of labor market health right now, because the break-even rate of payroll gains is really shifted in the past couple months due to changes in immigration policy, as well as the uptick in retirements that we've seen. So that's a really important way to interpret the payroll data. That is to say, it is changing, but the unemployment rate is really a better gauge of labor market health, and that's just something we're not going to get.
So Brandon, as this government shutdown persists, the questions we all have about possible impacts and ripple effects, economy, labor market, Fed, rates, has it caused you, Brandon, to reconsider in any way how and where you want to put money to work?
Not dramatically, because we are, like I said, in day 8, so that's certainly something that you have to take into account, but thus far hasn't caused any major shifts in some of the underpinnings. Earnings remain strong. We still have kind of this U.S. exceptionalism that remains. Obviously, mega cap, big tech, those continue to propel markets forward. You're starting to see an emerging trade in small caps. So over the last several days, that hasn't necessarily changed things. It does make you stop and pause, though, and say, in the absence of this data, how can the market continue to propel forward, especially as this drags on further? But what that doesn't change, though, is underlying earnings, which have been dramatically increasing. In fact, there's only been 5 times since 2003 that growth estimates have been revised higher into an earnings season like we're about to have. Q3 has ticked up from 8 to 8.8%. So really some underlying strength there in markets.
Brandon, Michael, thank you guys. Appreciate it.
Thanks for having me.
Coming up, airline earnings taking off. Are investors on board with what they see? More on that when we return. Stick with us. Shares of Ferrari skidding as the car maker provides an outlook that failed to meet the street's high expectations. Here with more, Yahoo Finance's Praz Submarinian. Praz.
Josh, I know you're a big fan of Ferrari, as am I, and the stock is actually loved a lot by analysts and investors, but because of that strong margins and earnings part of the stock usually has. But Ferrari can be conservative. We saw that today. They said their 2025 net revenue would come in or exceed 8.24 billion, up from a prior projection, but not high enough for investors in a stock that trades at 40 times forward earnings. So looking at their longer term 2030 goal, they talk about a target of 10.5 billion revenue on adjusted EBITDA of 4.2 billion, which missed the mark again. Tom Narayan at RBC says that's a CAGR of about 6%, well below the 10% they had been saying back in 2022. So what's going on here? I think the big issue is that the company's in the midst of sort of trying to grow a business that caters to exclusivity. How do you grow a business where you're trying to keep the demand still wanting, right? You want to basically sell one less car than you can actually make, right? But then you have to grow the business. Well, you want to see growth, right? So that's the spot they're in right now. And they'll likely focus on more special edition cars that have much higher margins, sort of bridge the gap to keep those quantities down, but the profits still high.
And what do they have to tell us, Praz, about their EV plans? Were there any updates there?
Like every other manufacturer, including a lot of luxury manufacturers, they were pushing into EVs. Only a couple of years back, they were talking about how EV sales would have been 40% of all sales, right, by 2030. Now they cut that in half to 20%. So they're still going to come out with EVs. They're going to kind of sell about half as much as they thought they would be, which brings us today where they actually revealed some details of their new upcoming Ferrari Electrica, which is their new full EV, right? It'll be a quad motor, 1,000 horsepower car, like a grand touring sedan type car, 4-seater. Interesting sound qualities where they're going to be pumping in sound from the motors, not a fake sound, but an actual pickup of the motors making that whir. It'll come out in 2026. So they're trying to build some enthusiasm for EVs, right? But, with Ferrari in particular, who's going to want to buy a car that's that sweet sounding V12? But Ferrari's known to talk to their clients ahead of time. They may have pre-sold a bunch. Maybe they sort of gathered some idea of what the excitement will be for that car, and they're going to release it. So we'll see how that sells next year.
Thank you, Praz. Appreciate it.
Thank you.
Well, Delta Airlines seeing a pop as the company tops earnings expectations for the third quarter and sees a significant improvement for its revenue outlook. Here for a closer look on whether clear skies are ahead for the industry. Let's welcome in now Raymond James Managing Director, Savi Syth. Savi, always good to see you. So let's start with Delta, actually. Reported this morning, Savi, investors like what they heard. This stock's popping, but I'm curious to get your take on the report. What did you think?
Thanks for having me, Josh. Yeah, it was fairly good news, especially on the revenue front. The demand recovery that they were starting to see at with the last earnings call, you've just seen that momentum continuing here, and good momentum going into the fourth quarter. And really, what's happening here is you had good momentum at the end of last year that kind of got sapped away with some of the demand impacts earlier this year. And I think we're finally getting back to a trajectory where we're returning to that momentum. So that was very well received here.
Bigger picture, you look at this airline industry right now, Savi, that you know so well. Do you see demand strengthening here, both consumer and corporate travel?
I mean, it definitely looks like corporate's coming back. You saw a pause in corporate travel, and you saw some hesitation on the consumer side too to travel. Again, with everything that was going on from a headline perspective, maybe not necessarily the economy slowing, but the headlines were causing some kind of concerns. And I think we're starting to kind of move away from that. Corporates coming back, maybe playing a little bit of catch up for some of the trips they didn't take. So those are all encouraging. We'll have to keep an eye on the economy. At the end of the day, that is the driver for demand. But as it stands right now, the trends are fairly positive from an airline perspective.
What about pricing power, Savi? I'm curious, what are the trends you see there? What are base fares doing?
Yeah, I mean, it's a little bit different in each of the different markets. In the domestic market, you have had now for a few years and several quarters where there's a group of airlines that aren't making that much money. And I think there are multiple reasons for that. Costs are higher significantly and just overcapacity in the main cabin side. But that's starting to get addressed. It was starting to get addressed end of last year. Unfortunately, the improvements that were being made was masked by the demand fall off earlier this year. But we're kind of, again, with demand coming back, more momentum on the capacity adjustment side, I think you're finally starting to get some pricing power back, especially in that main cabin section.
What about the government shutdown, Savi? I'm just curious what kind of potential impact and ripple effects that could have for the names you cover. What are you telling clients about that?
Yeah, there's kind of two impacts really, right? Like there's the very short-term impact, which historically has just been kind of the loss of that government travel. This year, because you saw a significant step down in government travel, I think the incremental impact is much smaller than you've seen historically. So it's very modest at this point. We're in the off season. I know there's a fall break going on, so maybe a little bit of peak, but within an off-peak season. So not a lot of flying going on. So if there are kind of lower staffing levels, you can handle that a little bit better. But there are kind of longer term concerns here. We've been trying to bring back ATC staffing levels. Well, when the government is shut down, you're not going through training, you're not building your ATC staffing levels. So there are some things that don't impact you immediately, but have longer term implications. So from an airline perspective, they'd love to see the government back, as soon as possible so that we don't have some longer term effects from this.
Finally, Savi, let's just quickly get to some picks here. Beyond Delta, which I know you like, why is SkyWest a strong buy?
Yeah, SkyWest is a very different business model than everywhere else. They fly for the legacy carriers in Alaska under their brand. Really well managed company, and they've done a really good job of using their strong balance sheet and their assets to really provide value to partners and thereby shareholders as well. That stock got hit among concerns, but when you think about the movement that we've had to some of the smaller cities from bigger cities, SkyWest is kind of well exposed to that because they really connect passengers to hubs for the legacy carriers in Alaska. And so, just on a relative basis, I think that's a stock that's still not done. There's more kind of opportunities for SkyWest to really restore service to small communities that have lost service, especially as the pilot supply issue gets resolved here in the near term. I think there's a lot more opportunity for them to expand earnings.
And Savi, quickly, just spinning ahead, United, I believe, reports next week. You're on a market perform there, Savi. You're on the sidelines. How come?
Yeah, and United's done a really good job. They've performed really well this year as well. So, nothing negative necessarily to say. Just on a relative basis, United has a lot more international exposure. And if we're thinking that the second derivative improvements here are really going to come from the domestic market. So we've favored a little, airlines with a little bit more domestic focus.
Savi, always great to see you. Thank you so much. Appreciate it. Coming up, more firms are holding digital currencies as a financial strategy. We're taking a deep dive into this new and evolving trend, that story, and more coming up. Welcome back. Bitcoin getting a boost this year thanks to the surge of digital asset treasuries. But what is a DAT exactly? Well, Inez Ferrari is here to explain. Inez.
Josh, a fast-rising trend in corporate finance, digital asset treasury companies. So what are they and what do they do? This is what they are. A digital asset treasury, basically called a DAT, is a business that holds a large amount of digital assets like Bitcoin, like Ethereum, on its balance sheet. And unlike traditional firms that hold cash or bonds, DATs raise capital through stock or debt, and then they deploy it to buy cryptocurrencies. Their valuation valuations often move in tandem with the value of those tokens. So here's how they operate. First, they raise the money and then they purchase the digital assets, often Bitcoin, sometimes it's Ethereum, and use specialized custody security systems to manage them. And then they can also lend those tokens out or stake them to generate extra yield. Their stocks trade at premiums or discounts based on the value of those holdings and investor sentiment. So who are the biggest players? Well, the giant in the space is Strategy, formerly known as MicroStrategy, led by Michael Saylor, the world's largest public company that's holding Bitcoin, the largest holding of Bitcoin. Other companies include Bitmine. You also have Mara Holdings, Metaplanet, SharpLink Gaming. These are some of the companies that have adopted crypto-heavy balance sheets. So in total, public companies now hold more than 1 million Bitcoin, roughly about 5% of the entire supply. So why the surge in interest? Well, first, you have institutional adoption that's accelerating from pension funds to hedge funds. More capital is entering the digital asset space. Also, you have regulatory clarity that's improving. That's making it easier for companies to hold and report digital assets. And many executives see Bitcoin as a hedge against inflation or just a more productive use of treasury cash. And finally, the market sees these companies as high beta ways to get crypto exposure without directly buying the tokens. When digital assets rally, their stocks rally, often soaring, but there is a warning. When crypto falls, the losses can also be sharp. Josh?
Thank you, Inez. Appreciate it. Well, Pepsi's latest earnings are giving investors a fresh read on the consumer. Results come as the broader beverage space we know faces shifting tastes, activist investors, and pressure to provide healthier options. We're navigating how to play the beverage sector with the Yahoo Finance playbook. And joining me now, we got Peter Galbo, food and beverage analyst at BofA Securities. Peter, always great to see you. Let's just start with Pepsi's earnings results. Investors seem to like what they saw here. The stock's popping about 4% right now, but I'm curious to get your take, Peter. What do you think?
Yeah. Hey, Josh. I think as it relates to Pepsi this morning, what we saw is a few things. One was a much more positive tone out of CEO Ramon Laguarta, particularly around the Pepsi Foods North America business, or the old Frito Lay, where there's a lot of innovation that's coming in, particularly in the fourth quarter and early into next year. Some relaunches on some of the big brands like Lay's. You saw the brand refresh come out this morning as well, and Tostitos, that are maybe starting to drive some hope and optimism that the salty snack sector, which has been under a lot of pressure, is actually improving. I think when you look at the beverages side for Pepsi, trademark Pepsi has been a little bit maligned over the past several years. And what you're starting to see, I think, are some nascent improvements, both in the away from home channel, the at home channel, with some of the Pepsi products, particularly some of the zero sugar, which are regaining their footing. And so I think that's what's driving the shares higher today.
And Peter, we did just actually talk to the Pepsi CEO about his talks with activist investor Elliott Management. Here's what he had to say. Take a listen to this.
Most of the things that Elliott is proposing, we're doing already. They're part of our PepsiCo 2030 strategy. We mentioned SKU rationalization, reducing costs to reinvest in growth, adding some new innovation and portfolio in fast-growing areas, et cetera, et cetera. There's a couple of areas where we need to have more discussion with Elliott. One of that is refranchising. Another one is, do we need to prune the portfolio? And we're open to any ideas.
So I'm just curious what you make of that, Peter. How do you think these talks between Pepsi and Elliott, how are they going to shake out?
Yeah, Josh, I think that, again, what you heard from Ramon there and what's been consistent in the messaging from Pepsi is that a lot of the things suggested by the activists are kind of already in motion at Pepsi, particularly on the Frito Lay side and what's been proposed, rationalizing the footprint. You saw Pepsi close some plants earlier this year that were a bit older, maybe at the end of their useful lives. And so you're seeing some of that in motion. I think when it comes to the refranchising of the bottlers, there's kind of a twofold argument. This has been around as an idea for over a decade. It was the last time that Pepsi underwent some activist pressure. This was a push for refranchising. Coke obviously went through this pretty aggressively in the mid-2010s and has ultimately come out the other side of it in a very positive direction. But I think in the time it took Coke, it was like a 5-year journey for them to really see the benefits of the refranchising. So it's an option, but it's not a quick fix.
Let me ask you, Peter, I don't know if you caught this, but the Journal had a story out, kind of talking potato chips, Peter, and they were talking about how Lay's, part of the PepsiCo empire, of course, how later this fall, it's going to include the new phrase, made with real potatoes. And I'm just curious, why do you think they're doing that, Peter?
So go back to the Super Bowl, Josh, when the first commercial came out as it relates to showing you the potato being grown, the little girl who picks it brings it, to her father, and then that, ultimately becomes the potato chip, right? They showed you the journey of the potato. I think as consumers are becoming much more conscious about, where their food comes from, wanting to make sure that, they can source it, that they know that it is not artificial, that probably plays into what's happening with some of the language there on Lay's.
All right, so we talked PepsiCo, Peter. I know I believe you have a neutral on that one. What about Constellation Brands, where I think you got an underperform, Peter, so the equivalent of a sell? I wanted your take on those results. So they did report this week as well, better than expected results. You do hear about this trend, Peter, younger folks maybe drinking less, either it's health reasons or cannabis, but what did you make of Constellation?
So again, these were results that were released after Constellation had actually negatively pre-announced back in early September. So a bit better versus a lower bar that had come out earlier this month or earlier last month. I still don't think Constellation is out of the woods yet from the beer business standpoint. You're seeing consumption metrics continue to be relatively weak. They're not through the worst of it. Actually, as you look out over the next couple of months, some of the comparisons on the growth rates become more difficult relative to last year before they start to ease into a bit easier numbers around December and into the new year. But I do think it gets back to this question around kind of structural versus cyclical in alcohol consumption right now. We've leaned much more on that this may be a structural change as some of the younger generations who account for the vast majority of alcohol consumption are drinking less than prior generations. That's Gen Z drinking, less than my generation drinks. That's my generation drinking less than my parents drink or drank when they were our age. So I do think that's much more of a structural headwind that we're seeing across alcohol in general.
So quickly, Peter, I only have 30 seconds, but if PepsiCo's a neutral and Constellation's an underperform, give me a buy here.
Yeah, we still like Coke. So Coca-Cola is a top pick for us. In beverages, we think that the company is poised to still kind of hit that mid-single digit, call it 4 to 5% growth rate here over the next several quarters. And that'll really help it stand out, not only versus its beverage peers, but relative to a lot of the other multinational peers that have exposure all over the globe.
Peter, always good to see you. Thank you, sir.
Thanks very much.
Well, shares of cannabis company Tilray soaring after reporting quarterly earnings Thursday. Julie Hyman did speak to the Tilray CEO Irwin Simon earlier on Market Catalyst.
Our Canadian cannabis business, was up mid to high single digits. Our international cannabis business was up, mid to high single digits. Our beer business was basically flat. So from a standpoint, cannabis had a really good quarter for us. And, we're in the midst right now of integrating all these beer businesses that we bought. We went through a major SKU rationalization. We also have gone through where we were delisted and buying some of these products and getting them relisted again, and the timing and when all that is happening. So, that's why it's so important to be a diversified company, Julie, because not everything happens at the same time, and you got some good ones and you got some bad ones out there, and hopefully the good ones make up for the bad ones.
Yeah, and when you bought some of those beer brands, we talked about them a little bit, and at the time I said to you, okay, so how do you buy these beer brands and make them better? How do you turn the sales higher? As you say, you're in the process of kind of doing that, rationalizing the SKUs, changing the marketing, what have you. So where are we in that? Do you expect sort of a bigger unlock at some point? Because I know some of the overall secular trends are against you with beer consumption as well.
Listen, the beer category is not growing. If anything, is declining. On the other hand, what I come back and say is this here. We own today over 18 different brands and regional brands, and you see some unique brands. And my strategy is when we got in the beer business was how to make beer fun again? And how do we come out with some innovation? And that's what we've been doing, whether it's the non-alc, some of our, lighter beers, some of our unique beers, and we're seeing some of that paying off for us. The other thing is when we bought some of the brands from whether it was Molson's or from ABI, just from the timing, most of these brands were declining. So number one, we went through SKU rationalization to clean up some of the SKUs. And number two is innovation, but now getting them relisted out there and getting distributors excited about them. The other thing is we originally had 10 breweries out there, integrating some of our breweries and taking costs out. So far, we've taken $25 million of cost out, and there's more to do. So, again, we only been in the beer business since the end of 2020, and, we've brought 12, 13 brands together and just trying to get all the efficiencies of cost, the infrastructure, the sales organization, the sponsorship, and not only selling beer at retail, is getting these brands on tap at all the different bars out there is something we, been trying to do. A lot of innovation on non-alc we've done, a lot of innovation on some of our energy drinks that we're doing, a lot of innovation on our vodka seltzers and that we're trying to do too. And last but not least is Delta 9 product we've introduced last year, which is hemp-infused drinks, and whether it's 5 or 10 milligram, and it's only legal today in about 14 states. We're seeing some really good success, from that. Listen, you talked about Dr. Pepper before and some of the demands for that. Consumers want beverages. Beverages is one of the biggest categories out there, and I think they're replacing a lot of these sodas with some of these unique drinks that we're coming out with.
Yeah, as we're seeing the rate of people drinking alcohol go down a little bit too. Erwin, as always, I got to ask you about the regulatory environment. And the latest on that, as I mentioned before, was President Trump tweeting out this video on CBD and sort of suggesting its benefits for older people in particular. But we haven't seen any actual real movement from the administration, right? It looks like the rescheduling conversation is getting pushed back a little bit. Are you getting any signals from them directly about what's going on that front?
No, I wish I could say I have, but I have not at all. The only thing is this here. When Trump talks about something, he's an action-packed person. He gets something done. And I think one of the big things, what he's realizing is what cannabis, what CBD, how significant it has been in medical research, how it's been significant in international markets, and how it's been significant in the Canadian market. And Julie, we are also getting outreach from other countries, whether it's in India, Middle East, and stuff like that, about cannabis from a medical standpoint. And again, with that, it gives me confidence that something will happen on rescheduling. And, President Trump does not tweet something in regards to, CBD or medical cannabis unless he's got an action plan.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.